The FSCA Commissioner told delegates that regulators must constantly adapt their frameworks to new risks. This, he says, will ensure agility, robust supervision, alignment with international standards, and sensitivity to economic dynamism to avoid stifling innovation.
Regulatory frameworks must be sensitive to economic dynamism. Let me say that again. Regulatory frameworks, regulation, must be sensitive to economic dynamism, because regulation intended to safeguard public trust in markets should not end up stifling innovation and growth, risking killing the very markets it is designed to protect.
Kamlana outlined the FSCA strategy to navigate global uncertainties, structural shifts, and technological advancements. These include the Financial Markets Act's review, the regulatory framework for central clearing, and enhancing market infrastructure standards, among others.
The FSCA, working with key stakeholders, is piloting the implementation of the South African Green Finance Taxonomy to evaluate how best to encourage its use, aligning with global approaches and supporting consistent disclosures. For sustainable finance to be credible, disclosure must be transparent, comparable, and decision useful. With the support of the IFC, we are considering the introduction of sustainability disclosure requirements to promote capital market transparency and ensure continued alignment with international standards. In doing so, the FSCA is working towards the adoption of the ISSB's IFRS S1 and S2 standards as the global baseline, ensuring that South Africa's disclosure framework is internationally comparable, credible, and aligned with the emerging best practice in the world.
The Commissioner also addressed the future of public markets. He acknowledged the global trend of declining listed companies in South Africa due to structural, macroeconomic, and microeconomic pressures.
We cannot ignore the reality that the number of listed companies has been declining, mirroring a trend where more firms choose private capital over public listing. While we understand that this may not simply be a matter of choice, it reflects deep-seated structural, macroeconomic, and microeconomic pressures, low liquidity and weak investor demand, coupled with slow economic growth and persistent uncertainties, which have dampened investor appetite and depressed company valuations, leaving listed firms with limited scope to thrive. Furthermore, the compliance and reporting burden associated with a public listing remains disproportionately heavy for smaller firms, adding to the financial strain. We welcome efforts by exchanges to reduce the complexity of listings and to expand programs aimed at improving liquidity, steps which are essential if public markets are to remain relevant and inclusive. For us as regulators, this goes to the very heart of market integrity.
Diabosito, SABC News, Johannesburg.